If you pay taxes, then you're probably doing it wrong. Here's all the dirty IRS secrets they don't want to tell you about. Now, here's the first thing you do. Don't report any of your income. JK, please don't commit tax fraud. But seriously, nearly half of all Americans pay too much on their taxes. And if you're a part of that, then this video is for you. This video will tell you everything you need to know in order to reduce your tax payments. Now, if you found this video helpful, make sure you hit that subscribe button to keep up with all the content. Now, the first and most important thing that we have to talk about is tax advantage accounts. Now, there's quite a few different of these accounts, but let's just start with the most obvious one, which are retirement accounts. Retirement accounts are one of the most effective ways to save on taxes because when you're contributing to them, they're typically tax advantaged. Now, these would typically include 401ks, traditional IRAs, or Roth IRAs, and each of them have their specific benefits. Annual contributions they make to these accounts may be tax deductible in the case of traditional IRAs and Roth IRAs, or they can grow tax-free and are not taxed when withdrawal in the case of Roth IRAs, which helps individuals reduce their taxable income and potentially defer taxes until retirement. Now, here's the main difference between a traditional IRA versus a Roth IRA. With a traditional IRA, the money that you put in is pre-tax. However, the withdrawals that are later made from that account are then taxed. With a Roth IRA, the income that you put in is after tax. Your investments in this account grow tax-free, and when you later withdraw it, it is also completely tax-free. Which means if you expect to make more money in the future, then it's a better idea to put more money into your Roth IRA versus a traditional IRA, whereas if you're expecting to make the same or even less, putting you in a lower tax bracket, then you might consider putting your money into a traditional IRA. Moreover, we also have to talk about 401ks. These are an example of an employer-sponsored retirement plans, which are also tax deductible. Moreover, many employers offer matching contributions, which essentially provides free money and boosts retirement savings while reducing taxable income. 401ks, traditional IRAs, and Roth IRAs are all great ways to reduce your taxable income whether now or in the future. So if you don't already have one, make sure you sign up for one, and you can easily do so with most brokerages or banks. However, retirement accounts aren't the only tax advantage accounts. Other popular options include the HSA, which offers a triple tax advantage, which means that contributions are tax deductible, earnings grow tax-free, and withdrawals for qualified medical expenses are completely tax-free as well. It basically takes the best of both traditional IRAs and Roth IRAs and combines it into one. The only caveat is that you have to spend it on medical bills. However, if you're a human, you're probably bound to have medical bills anyways, so it probably doesn't matter. You should be maximizing your contributions to HSAs to save on taxes while building a nest egg for healthcare expenses in retirement. Moreover, there are also other accounts like the 529 plan, which is basically a savings account that is made by the state or an educational institution. Money that you're saving for higher education can typically be put into these accounts, and while you can't deduct your contributions on federal income taxes, you'll probably be able to on your state returns, which will definitely shave some money off of your tax bill too. And the last one I'll mention in this section is an FSA, which is a flexible spending account. This account takes tax-free dollars directly from your paycheck, and you'll typically be able to use it for medical expenses or related everyday items. However, the contribution limit for this account is incredibly low, so make sure you just keep that in mind. Now that we've discussed where you need to put your money, now let's discuss how to actually reduce those taxes. There's simply two ways to reduce the amount of taxes that you're paying: tax deductions and tax credits. Tax deductions reduce the taxable income amount. They're subtracted from your gross income and thereby lowering the amount of income that is subject to taxation. However, tax credits, on the other hand, directly reduces the amount of tax owed dollar for dollar, and they're typically applied after the calculation of your tax liability. So, TLDR, they both result in a lower tax bill, but tax credits are just a little bit more direct. The first and most important thing that you should probably do is itemize your deductions. For individuals who have deductible expenses, itemizing them can result in significant tax savings. Common deductible expenses include mortgage interest, property taxes, state and local taxes, charitable contributions, and medical expenses exceeding a certain threshold. Now, speaking of mortgage, we also have to talk about mortgage points. A mortgage point is basically equal to 1% of the amount of your loan for that house. So for example, if you have a $100,000 home loan, then one mortgage point of that is equivalent to $1,000. Now, there's a lot of qualifying factors for this deduction. However, the key thing they have to know is that this deduction only works on your primary residence. So if you have other rental properties or other real estate investments, those will not be deductible. Moreover, with many lenders, each mortgage discount point that you pay will typically result in a reduction of your loan rate, usually by about 0.25%. And while typically you do have to pay more money up front to capitalize on this deduction, it'll still save you more money in the long term. But with where mortgage rates are right now, this strategy might not even be viable. But just keep it in mind. Now, speaking of itemized deductions, we also have to talk about charitable contributions. Now, it's a great time to be donating to charity because the current federal gift and estate tax exemptions will drop back to the base level of $5 million for individuals and $10 million for couples. Now, for a typical individual, you're probably not going to be dealing with $5 million of charitable giving. Even if you aren't working with $5 million, any clothes, food, hygiene products, or any other household items that you might be donating are still deductible. So you should probably write down what you're donating before dropping it off at the thrift store. Moreover, you should also take advantage of tax credits. Tax credits directly reduce the amount of taxes owed, making them highly valuable. Examples of this will typically include the Earned Income Tax Credit, Child Tax Credit, as well as Clean Energy Tax Credit. There's nearly $400 billion for clean energy tax credits that you can easily take advantage of by buying new or used electric vehicles, installing residential energy properties, and other steps. So if you are thinking about buying the newest model of Tesla, make sure you take advantage of this as well. Also, if your income doesn't exceed that $60,000 to $70,000 threshold, then you might also look into the EITC, or the Earned Income Tax Credit. Typically, depending on your income, you might qualify for a tax credit up to $7,430 for taxes filed in 2024, which is another great way to save on your bill. Now, if you can take advantage of all of that, there's still a couple of other things that you could do to reduce your tax bill. First thing that you might want to look into is municipal bonds. Municipal bonds, or munis, are issued by the state and local governments and are exempt from federal income tax, and might also be exempt from state and local taxes if purchased within your state of residence. The interest earned on munis are completely tax-free, which are especially helpful for individuals in higher tax brackets. However, if you take a deeper look, you'll notice that you're only earning around 3% interest on these bonds. However, if you're in a really high tax bracket and have to pay almost 40% of your income to taxes, these munis can make about a 7-8% difference for you. Moreover, towards the end of the year, it is also a great idea to harvest any losses. Tax loss harvesting involves selling investments that have experienced losses to offset capital gains and reduce your taxable income. Any loss that you incur during the year can be used to offset gains dollar for dollar and can be carried forward to future tax years as well. So if you have a lot of money in your portfolio and the S&P 500 has just a terrible year, then you might want to look into this as well. And finally, if you're not sure what to do, you should always consult with a tax professional. Tax laws are super complex and subject to change, so consulting with a qualified tax professional can help you navigate tax planning strategies tailored to your specific financial situations and goals. If you're working with a large amount of money and various income streams, taxes can be incredibly confusing, which is why it might be a smart idea to consult with any tax professionals out there. Anyways, those are some of the ways that you can reduce your tax payments. And if you found this video helpful, make sure you hit that subscribe button.